I entered a trade before the release of non-farm payroll news, anticipating that if the reported number surpassed forecasts, the price of the pound-dollar would quickly rise, allowing me to make a substantial short-term profit. The news gets out, and as I expected, the number beats forecasts. However, to my surprise, the price goes down instead of up. I reflected on all the analysis I'd conducted, all the reasons the pound sterling should be on the rise. But the more I dwell on it, the further the price falls. My emotions took over as I witnessed losses piling up on my position. This is the moment known as the fight, flight, or freeze moment. And it's moments like this that hinder us from achieving our profit goals. And for traders, it can be particularly troublesome, leading to impulsive reactions. Make no mistake, it isn't only when we're in a losing position that our emotions and impulses take over. They can get you even while you're seemingly ahead in the market. Let's look at how emotions ruined it all for my friend Alex. Alex is a seasoned trader with years of experience in the stock market. He had a well-defined strategy, a meticulous trading plan, and access to the latest market data. However, despite his preparation, Alex often succumbs to the emotional roller coaster of the trading world. The asset Alex was trading went on a bullish trend. Euphoria and greed got a hold of Alex. Despite watching his profits soar, he couldn't resist the allure of even greater profits. So he doubled down on positions, disregarding his initial risk management rules. When the inevitable market correction occurred, fear gripped him. Panic set in, leading to impulsive selling and locking in significant losses. This emotional turmoil is not unique to Alex and me. Traders worldwide face the same struggle, juggling the psychological aspects of trading with the cold, hard facts of the market. If you are like Alex and me and have been looking for answers on how to overcome the emotional roller coaster called trading, this video is for you. In this video, I will discuss the 5 things you can do to overcome emotional setbacks as a trader and make decisions grounded in strategy rather than sentiment. Number 1. Develop a solid trading plan. Stop deceiving yourself. Trading is not the glamorous, quick-fix endeavor that some social media gurus might portray it to be. It's important to dispel the notion that trading is a get-rich-quick scheme. Instead, it is a journey that demands dedication, discipline, and a realistic understanding of its challenges. The misleading idea of rapid wealth accumulation, often propagated on social media platforms, can set you up for disappointment and failure because trading is not about hitting the jackpot overnight. Rather, it's a process that requires time, education, and a steadfast commitment to learning from both successes and failures. To navigate this complex journey successfully, you must acknowledge the need for a well-constructed roadmap, a trading plan. This plan should be more than just a vague outline. It should be a detailed strategy that involves identifying and accepting your risk tolerance levels, entry and exit points, and profit targets. Consider the trading plan as the compass guiding you through the unpredictable waves of the market. With a comprehensive plan in place, you will be better equipped to make informed decisions, regardless of the emotional highs and lows that come with trading. It will act as a constant reference point, helping you stay on course and avoid succumbing to impulsive actions driven by momentary market fluctuations. Remember, success in trading is about consistency, discipline, and the ability to adhere to a well-defined path rather than chasing elusive shortcuts to wealth. Number 2. Embrace mindfulness and emotional awareness. Your calm mind is the ultimate weapon against your challenges, so relax. Bryant McGill. Mindfulness at its core is about being fully present and engaged in the current moment. It involves paying attention to thoughts and feelings without judgment, allowing for a heightened awareness of one's mental and emotional state. In trading, this awareness is instrumental in preventing impulsive decisions driven by fleeting emotions. Recognizing the power of emotions and incorporating mindfulness techniques is not just a theoretical suggestion. It is a practical necessity for traders navigating the unpredictable currents of the market. Imagine you are faced with a sudden market downturn. Without mindfulness, emotions like fear or panic might take the wheel, prompting hasty decisions such as selling off assets impulsively. On the other hand, a mindful trader would acknowledge these emotions without being controlled by them, allowing for a more rational response, perhaps waiting for the market to stabilize or sticking to a well-thought-out plan. Think about those positions you have opened early and those you closed late. If you were mindful, perhaps the result could have been different. Traders who cultivate emotional awareness can pinpoint when fear, greed, or other emotions start influencing their decisions. Whether you are a seasoned trader or someone simply seeking a more centered existence, the principles of mindfulness offer a practical and accessible pathway to better decision-making and enhanced emotional well-being. By incorporating these practices, traders can cultivate a mindset that not only thrives amid uncertainty, but also fosters sustained success in the ever-evolving landscape of the markets. 3. Keep a trading journal. A trading journal is like a personal diary for traders, but instead of secrets, it keeps a record of every decision made in the financial world. Keeping a trading journal is like having a special tool that helps traders become better at what they do. It's not just about writing down what happened. It's like a guide that keeps you on track and helps you learn from experiences. By writing down things like when you buy or sell, how much you risked, and other important details, you will create a factual trail that will help you stay responsible for every choice you make. In your journal, you will find patterns and strategies that always lead to good results, and recognizing these successful approaches will help you make smarter decisions, creating a plan that brings more success in the future. We all make mistakes, but a trading journal turns these mistakes into lessons. By looking back at past trades without letting emotions cloud judgment, you will learn from errors and become better at what you do. A quick tip for using a trading journal. Writing in the journal regularly and being detailed helps create a full story of a trader's journey, including things like why a trade was made, what the market was like, and how you felt at the time gives a complete picture. Tracking progress towards goals, like making a certain amount of money, can keep you motivated and focused. To conclude, a trading journal is more than just a record keeper. It's like a trusted companion that helps traders be responsible, learn from experiences, and stay on the path to success. Keeping a detailed trading journal is an investment in becoming a better, more resilient trader in the exciting and ever-changing world of financial markets. Number 4. Risk management is your safety net. In all the videos I've created about trading psychology and other topics, I've consistently emphasized the importance of risk management in each one. The reason is simple. Where uncertainties loom large, practicing effective risk management is a crucial skill for success and an effective way to keep emotions in check as traders. You can call it a trader's psychological safety net. Knowing when to exit a trade, even before you enter it, acts like a safety net for your mind. It helps to ease the psychological pressure of making decisions in the heat of the moment. When the market gets intense and emotions run high, having a predefined exit point provides a sense of control and reduces the anxiety associated with trading. Fear is a powerful emotion, especially in trading. It can make traders act impulsively, leading to decisions they might regret later. But by setting clear stop-loss orders, you create a plan ahead of time. This plan acts as a guide, preventing fear from taking over and causing you to exit a trade too soon. It's a strategic move to stay calm in the face of market fluctuations. Before entering a trade, determine how much of your capital you are willing to risk. This sets the foundation for setting an appropriate stop-loss level. You can use technical analysis like the moving average and market data to identify strategic points for placing stop-loss orders. This could be based on support and resistance levels or other indicators that align with your trading strategy. Once you've set your stop-loss order, stick to it. Trust the plan you've put in place and resist the temptation to change it based on short-term market movements or emotions. In conclusion, applying proper risk management to your trading is not just a protective measure. It's a smart strategy. It safeguards your capital, provides a psychological safety net, and helps you stay disciplined in the face of market uncertainties. 5. Continuous education and adaptability. In trading, the twin pillars of continuous education and adaptability serve as indispensable assets for traders navigating the dynamic landscape. Continuous education is akin to adding new tools to a trader's arsenal, ensuring they stay abreast of evolving strategies, market trends, and technological advancements. Not only does the ongoing learning process enhance technical skills, but it also instills confidence, acting as a counterforce against the fear stemming from market uncertainty. A well-informed trader armed with the latest knowledge approaches decision-making with a heightened level of assurance. Adaptability, a parallel necessity, recognizes the inherent dynamism of financial markets. A trader's ability to adjust strategies in response to changing market conditions is analogous to a skilled surfer riding unpredictable waves. Not only does this adaptability protect traders from being caught off guard by sudden market shifts, but it also fosters emotional resilience. Adaptable traders view change as an opportunity for growth rather than a threat, staying focused on goals and avoiding impulsive decisions driven by emotions like fear or greed. Practical implementation of these principles involves staying informed through regular engagement with market news, financial analyses, and educational programs. Learning from experience and actively reviewing both successful and unsuccessful trades forms a crucial part of this process. By committing to continuous education and embracing adaptability, you position yourself not merely to survive, but to thrive and overcome the emotional setbacks in the ever-changing world of financial trading. If you would like to learn more about trading psychology, I made a video where I shared my story, what I have learned about the market in my roller coaster journey as a trader. And if you made it to the end of this video, I say well done. If you found the video useful, please share, like the video, subscribe to the channel, and turn on the notification bell so you don't miss videos like this in the future. Thanks for watching.